Welcome to Subramani. This being the last month of the calendar year, I thought I'll talk about some things which people tend to assume, especially in a bull market. It could either be you yourself thinking like this, or your advisor could be making you think like this. Let us look at some of the mistakes that we make and which are worth avoiding. So typically you would think, in 2021 or whatever period you take, I've got 60% return, right? Or the advisor telling you, sir, in 2021 I got you 60% return. Completely wrong, right? Neither did you get it, nor did your advisor get it. Of course you got it, it's visible in your portfolio, but don't start taking credit for it. The only credit for that is to you, because you did not get out of the market maybe in March 2020. Maybe you sat tight through it. Apart from that, none of us knew that the market will give this kind of a return just during a pandemic, right? But it has happened. I'm not getting into the reason. So first of all, to make out the difference between a bull run and being a brilliant investor, bull market is the wrong time to be looking at it. You should be saying, I'm a great investor in a complete bear market. In a bull market, everybody looks smart, right? The second mistake we make is, suppose you're sitting now in, say, December 2021, and you've already achieved the amount in absolute terms, the money that you need for a goal in, say, 2024. You have reached it, and then you're saying, let it still remain in equity, because anyway equity is doing well. Whenever I sell equity, it looks like I look like an idiot. The market looks much smarter, so let this money remain in equity. Wrong, completely wrong. Whatever be the goal, let us say the goal is your daughter reaching class 12, and then you may have to pay for engineering or medicine, and for that you have kept the money. Remember, that's a very hard date goal. It's not like your retirement, your daughter's class 12, your son's class 12, right? Any of these things are very hard goals. They're exactly on a particular date. Now marriage could be a date from, say, 2024 to 2027. There could be some flexibility, but still, if you find a relationship which you're going ahead with the marriage in 2024, then you need the money in 2024. You cannot say, oh, the market is doing badly, I'll remove the money in 2027. So know the difference between hard goals and goals which could become hard, right? It's not like buying a house is something completely your decision, but your daughter's marriage or your son's marriage is not completely your decision. Yes, you are a big influencer, but you cannot choose the date. Or you can choose the date a little here and there. You cannot wait for the market to revive and say, now I have money, I'll perform my daughter's wedding. That doesn't happen. So these are goals. If you have already achieved in absolute terms the money that you require for 2024, then 90% of that money you take and put it into debt instruments. It could be something like ultra short bond fund or something like that. And say, okay, over 3 years, let it be there. After that, I'll pay short-term capital gain. After that I'll pay long-term capital gain, and 10% can remain in equity, saying, okay, it may provide an upside, but other than that, don't. Equity is a wrong asset class, especially if you know the date on which you have to withdraw. This is the job of the advisor also. Advisor should not be telling you, sir, theek hai, you will do better, let it remain in equity. So this is a lesson for both the client who thinks that equity is the only asset class, and the advisor who thinks, equity you get such fantastic returns that whenever you sell, you look like an idiot. Asset allocation is the ability and willingness to look like an idiot in the short run, so that in the long run you look smart, right? Then the other mistake we make is to say, okay, based on the current CAGR, which we are taking an average, right? So it's okay. Based on this CAGR, can we put less amounts for a target which we have to reach in 2027? Right now, this looks very tempting, because 2027 is 6 years away. You are doing say 50,000 per month SIP for meeting a particular target. Then based on the current year performance, you say, oh, I think 37,000 is enough, or 33,000 is enough, because the corpus has already grown a lot. completely wrong. Don't ever make a mistake based on current one bull market, right? Because what happens is, even if you take the CAGR is hugely influenced by this last 1 year return of 60%. On an average, when you're getting 12, one figure of 60 can dramatically change the amount. So don't take any decision based on the current CAGR. The current CAGR is terribly impacted by the last 1 year return. So don't do that. If you want, you take a last 6-7 years rolling return, but be careful. The impact of a 60% can be dramatic even on a 12, even on a 5-6 year basis, right? So be careful about that. Another mistake which advisors and clients make is to think, 2021 was fantastic, I got 60% return, but 2022 won't be too bad, I'll get at least 18-19% return. No, completely wrong. 60% return can be followed by a minus 12% return or by a minus 14% return. There is absolutely nothing to show us that the markets will go up. I mean, market could go up. I am not even saying market can't go up, but you don't assume that the market must go up because you are invested. We are all invested. We all want a bull market, but we all have to also understand that it can't be a permanent bull market. Then everybody will leave every other profession and just be sitting at the terminal trying to make money. Somebody has to really go and work in the real economy, right? So don't pretend that, oh, this is easy money. It's not going to be easy money. Maybe there was easy money. Maybe there will be easy money for a few people. But based on the data that people are giving from big broking companies, I don't think everybody is making money. A lot of people are losing money, right? So don't tell your customer that 20% to kahin nahi gaya. Last year was 60%. Now this year at least you'll get 20. You may not. Sectoral calls. This is another thing to worry about. I come on television, somebody asks me, which is the best sector to be entering now? I know which sector you should not be entering now. Go and look at the sector which is doing very well. If let's say it has given 67% return last year, 1 year, or 72% return last 1 year, that is exactly the fund in which you should not be investing, because the best has already come. So you should be investing in a sector fund, in a sector fund which is not performing at all, which is performed very badly, and that in this market does not seem to be available. So stay away from sector funds. You will find sector funds coming to you much cheaper. Maybe a real estate fund has not done well. I don't know. I'm just talking intuitively. I have no clue what has happened. Then maybe that's a good fund to invest. But then you may also look at the last 3-4 years experience of being in the fund and find that it has just gone nowhere. So will it do another 1 more year of going nowhere? Perhaps yes. So be careful about sectoral funds. This is not the right time to be looking at the sectoral fund unless you are really good at it. And another worry is for the investor himself and for the slightly less experienced advisor to say, oh, look at what fantastic returns, let us change the asset allocation. At the end of a bull market or end of the bear market is not the time to change asset allocation. Asset allocation is something which you should have arrived long back and thought about it and make all very small changes. You are 65 years of age, now you are 66. You want to shift 1% from equity to debt, makes sense. You want to shift 1% from debt to equity because you are underweight in equity, may not be a great time to do it. But arrive at your asset allocation after a lot of deliberation. This is not the best time to be reviewing your asset allocation or your sectoral calls. Both of them, this is not the best time to do it. Don't also assume that taxation rates will remain same, because I'm very convinced that this government is very, very leftist, and expect some changes which will be to the negative. Expect some kind of negative things. I don't know what. Increase in long-term capital gain, increase in short-term capital gain, increase in STT. Something will come because they find that it is easy money. Just go. The government is also greedy. It's the only winner in this bull market. The amount of STT they collect, the amount of stamp duty they collect, it is not funny. So they are making capital gains that they will collect. It's not funny, but that's okay. We will live with that. Let us first also admit we have no clue what 2022 will do. Let us also go and tell all our clients, friends, everybody that we were lucky that we got these returns. This may or may not be repeated in our lifetime, may not be repeated in 2022 for sure. One more thing which you should do during a bull run where you have got 60% return, etc., is to remove some money and pay off some amount of your debt, right? So if you have a let's say you have a large amount of debt, your CTC is about 20 lakhs a year and your debt is about 1.2 crores, which means you have 6 years income as debt. It's a great time to be booking some profits and sell off and pay off maybe 10 lakhs out of your loan. Not too much, but that is still 50% of your CTC. That's a good number to pay off. Suppose you are comfortable paying the current EMI, then continue to pay. But you have let's say you have ESOP and you got 27,000 shares of that company and you're sitting in huge amount of money. Sell 100 shares every month and repay the loan. So let us say the share price is 3,500. Sell off maybe 20 shares every month, that will be 70,000 rupees, and repay the debt along with your regular EMI. That's a good way to reduce your debt, and you're also booking some profits. But for heaven's sake, don't sell all the shares on one day. That does not make sense at all. Sell 10 shares every month. You don't know where the market is headed. Maybe after 2 years you have repaid a big portion of your loan and then you say, okay, I don't want to repay now, right? Perfectly possible. So check all that out. Don't overdo things in one shot, right? Especially at the end of what I would think a good year. Even in a calendar point of view, it has been a good year. So if you're sitting on great returns, enjoy it a little bit. Go and buy yourself some expensive toy. Maybe you, if the amount gained is decent, you go on a vacation, or you take your family to a 5-star hotel and blow some money, splurge, so that when they ask you why are you doing this, you can say, oh, equity returns I got and I thought some of that we should share. That is the way to create a positive mind positive mind impact on your children, so that tomorrow when they are investing in equity, they know, oh, we went to that 5-star hotel because dad made money in equity. Start telling the story loud within the house, but don't flaunt outside. But within the house, you say, oh, this is the reason, and that is why we are going and celebrating this. Maybe we are taking a vacation, whatever, right? So start enjoying your fruits also. But don't get carried away. Thank you.